Good morning. Welcome to IG's early morning call. It's Wednesday, the 6th of September. Let's take a look at the headlines as we wait what looks to be a slightly lower start to the European trading day ahead. The dollar basket is taking the headlines this morning. We've seen the highest print since mid-March this year. And this has meant that we've got the Japanese yen continuing on the downside. And in fact, we're there now at levels not seen in 10 months for the yen. And there's a lot of speculation in the market now that the Japanese authorities are standing by. What could be the trigger to them to allow them the opportunity to strengthen Japanese currency? In amongst some of the other headlines, WH Smith has come through with the trading update. It's all about the travel business. Revenue coming through, rising 28%. Travel is by far and away now the most interesting part of what WH Smith is doing, and it represents what we're hearing from airlines, that more of us are getting in the air to go to holiday destinations and for other things around the world. And we're also monitoring oil prices on the way up. Saudi Arabia and Russia are extending their voluntary cuts through to the end of the year. And this is an interesting trade that's beginning to develop on the upside. And the big concern is now it's going to continue to fuel inflation. Now let's move on to take a look at what's happening with volatility. We're holding on to what was essentially a day of gains yesterday, which means that people were taking risk off the table. And it is all about yields in the States especially, but yields generally on the way up. And concerns, as I say, going back to that business about oil. I'll take a look at oil in some more detail in just a minute and why it's beginning to bring through expectations that we won't see interest rates drop anytime in the near future. It doesn't necessarily mean to say we'll see interest rates fall down, but I think certainly inflation itself is likely to continue for the time being, at least, until we get through that period of comparisons between this year and last year. When we get through that, it'll be a very different thing. But inflation still remains. And so interest rates are likely to remain high at these elevated levels for an extended period of time. And that's what's really spooking the markets. I think if you look at what's happening with some of these markets, you can see at the moment, at least, we're now down below the 7,400 level for the FTSE 100. And the German DAX, French CAC 40, same sort of price action, this move on the way down. I was talking yesterday about putting your price at your stop loss, I beg your pardon, at 7,500. I'd certainly bring that in now and look at it something like around about 74.50 level. 73.95 is where we are. Where do we go from here? Well, I want to use some technical analysis tools to indicate to me more about what's happening. But let's put a Fibonacci on here, first of all, to work out where the next line of support is. You can see here, just before we talk about the fib levels, you can see the curling over of the MACD line here, which indicates to me that there's a picking up potentially on the downside for momentum. And when that crosses the red line, I'll be then really happy about going short on this market. I think there's still an argument to go short on this. We're not too far away from the bottom of the candle, meaning there are few buyers in the market at the moment. From 73.96, next line of support is at 73.33. which is the 61.8% retracement. And then you've got to go down to the three quarters, the 76.4% retracement, down at 72.88. So all these are likely support targets to work to if you're short on this market. And if you do have a price target to exit, that would be a really good one, first of all. And then you could regroup, take profits and move on. The total retracement would take you down to 72.15, which were the lows we had back on the 18th of August. And I said similar sort of price action on the other European markets. Well, that's true to a degree. We have at the moment very close to the fib support at 15,709. I haven't spoken to anybody about true fib traders, but we've seen a trade below there in the last couple of weeks or so. So I'm not completely convinced this is necessarily a particularly good line to follow. In fact, as I speak, I'm more minded to redraw the Fibonacci to take a look at what's happening in this current run here, and this little bit of a move here. And you can see we're very close to a line of support. The 61.8% at 15,688, very close to that. You get the candle close below there. The next line of support is the 15,600 level, and then down to 15,468, which for me is a more interesting level of support because you've got this rising red line here, which is the 200-day moving average. And that, for me, is a more interesting area of the market to watch out for, which would then look to receiving support at that 15,468. So I think potentially more downside to go. Certainly in the moment, so far as the markets are concerned, if we see a continuation, the belief that inflation is not unlikely to dissipate any time in the near future with the oil prices going up, Again, look at this MACD rolling over here. I'd be more inclined to put a longer term short trade on this if I get a close below the red dotted line, or a market trade below the red dotted line for the MACD, indicating momentum's picking up there on the downside. So it's an interesting session at the moment, and I think the short trader is definitely making money. Yesterday, we saw the French markets go all the way down to the red line, the 200-day moving average for the CAC 40. Not too far away from the 76.4% retracement. You can see here another attack. This line of prior support of 72.35 has succeeded. And indeed, at the moment, I'm not witnessing any buyers at the moment on the French markets. And the MACD has turned that corner. You can see here, just showing you what I was meaning about the MACD on the London markets and the French German DAX. French CAC 40 has picked up on the downside, indicating that people are looking for better prices to go short on this market. So if you're short on this, bring your stop in. I was talking yesterday about having the stop above the 50 period moving average, the green line up here around about the 73.50 level. I bring my stop in, lock in yesterday's profits, and continue to go short on this. Next price target is a 71.65, 76.4% retracement, which is very close to the red line here, the 200-day moving average. And then that total retracement takes you down to 50 points above the 7,000 level, the lows we saw back on the 7th of July. Good luck with that. Do keep your stop losses in place, and make sure that you continue to monitor trades as you go along. Lock in the profits and make your money on the way down on these markets. Now, overnight in Asia, markets continue, broadly speaking, to see losses. That being said, look at that. The Nikkei 225 up 2/3%. The benefits of a new 10-month low for the yen are boosting exporters. We were talking about this yesterday. But the market's also watching the likes of SoftBank, Arm kicking off its roadshow for its new initial public offering yesterday. FT reporting this morning what we were hearing yesterday on Tuesday as top fund managers casting doubt that the owner, SoftBank, would justify the valuation of around $50 billion. In the current market, it's going to be difficult getting it away. Many in the tech sector would hope that this might reignite some more interest in the sector. But many fund managers are saying, look, it just doesn't light the fire. It's just not enough. It's just not going to bring the spark that's needed in order to generate much more upside to these markets. Markets are not too far away from recent highs. And I think many are talking about concerns about the fact that some of these in the markets are trading at levels that are completely unsustainable, given the current environment, given the fact that interest rates are unlikely to get it down, given that inflation is unlikely to dissipate, given the fact that many people are now looking to go into yields rather than into risk assets such as equities. Hang Seng Stock Index barely changed in the day. S&P ASX 200 down 0.75%. I want to show you this chart, which is the Japanese 225. And look at this trend that we're in place here. Keep on bringing your stop up. I was talking, I think it might have been yesterday. I wasn't around on Monday. But my trade here is you continue to bring your stop loss up. Every single day, you get another tick higher, bring your stop loss up. The only one thing I'd say, and I'll go into more details about this in just a moment's time after we take a look at Wall Street, I do want to just talk about this in the context that with that 10-month high we saw yesterday for the dollar against that weaker Japanese yen, it's just a question now of waiting, I think, until the Japanese authorities take the rug from underneath the feet of those that are enjoying this rally here. And it is a rug that will be pulled at some point if the dollar continues to strengthen against the Japanese yen. The Japanese authorities will have no option but to intervene in the markets. They need low interest rates, which of course is why people want to steer away from the yen. There's no need to go into the yen at these levels when you consider what returns you're getting. So Nikkei 225 continuing to benefit. At the moment, we struck levels not seen there since the 1st of August. And as I said, until the Japanese authorities intervene, this is a trade that will continue. It's just a question about how much higher it will go. Look at that. I'm looking back at that point there. I seem to recall that was something like around about a 3-decade high for the Nikkei 225, that line at 34,015. So that is definitely going to be the price target. But it does depend very much on whether or not in the interim that we get any intervention from the Japanese authorities. Let's take away that dotted line there. Okay, so you've got here, you can see, yeah, these levels not seen since 1990. 15th of March. That was that record high, 38,950. And you can see that we're not too far away from the highs that we had there back on the 15th of June. So happy days for those long on Nikkei, so long as the Japanese authorities stand by and indicate their willingness to allow the Japanese yen to continue to weaken. I don't suspect that's going to go on longer. Let's take a look at Wall Street before we take a look into more detail about some of the other markets, including the yen in some more detail. It was a down day yesterday across the Wall Street panoply. Dow Industrials down, and you can see there the biggest mover actually down more than half of 1%. S&P 500, Nasdaq Composite also on the way down. I want to show you this chart here. You've got to bear in mind that we saw a Labor Day holiday on Monday. So the 24-hour markets were open on the IG platform. And in fact, you saw a bigger candle body there than you saw yesterday's overall session for the Nasdaq, where we saw us close pretty much where we started out the trading day. And indeed, that's exactly where we are at 15,472. It was a bit more of a move as you've seen for the Dow Industrials. That was that move that we saw yesterday. And indeed, that's exactly where the markets are as well. There's not much impetus, I don't think, not much we've seen overnight that might change things necessarily for anybody with a position on the US markets until the open today, when we'll doubtless get some more commentary from various people on what's happening, where the markets are going, what's likely to develop. Yesterday, we were hearing about the fact that Goldman Sachs had brought in their risks to recession in the US economy. It was only by 5 percentage points, but it was nonetheless a headline. And that's how far down we have to dig to get headlines. When Goldman Sachs changes its views on whether or not the economy is going to a recession by 5 percentage points. And that just highlights the point I'm messaging, that there really is not much around in the markets at the moment to steer direction. And I think that's going to continue so long as we get this continuation of the lack of other places to go in the market. At the moment, yields are playing well, and the US markets are suffering as a little bit as a result of that. It's all to play for. We're back at 1:30 this afternoon on Beat the Street. Join us then on the platform for that with Angeline Ong. She'll give you some more details about what's ahead of the start of today's trade. Now, let's take a look at what's happening in other areas of the markets, because yesterday we were talking about the recent lows for the Australian dollar. And not much has changed, despite the fact we got some better than expected GDP numbers coming through on the announcement. Yesterday, we saw the announcement from the central bank that it's decided to keep rates on hold. Today, we had the Aussie GDP numbers for the second quarter. The Australian economy expanded by a margin of 0.4% quarter on quarter, more than the 0.3% expected. Q1 GDP was also upwardly revised to 0.4%. Now, growth was driven by exports and investment, while household consumption, which used to be the engine of growth, remained subdued with just a 0.1% gain in the quarter. Capital expenditure up 2.4% quarter on quarter. A lot of money going into infrastructure projects, amongst other things. And as I said, we've seen that move in the Australian dollar. It is of interest. The move that we saw yesterday took us down there to levels that we'd not seen on this market since the 4th of November last year. So we're at 10-month lows for the Aussie against the US dollar. There's a little bit of upward movement, but to be honest with you, I think the more likely resolution to this would be 63 cents rather than 64. We're currently trading at 63.87. 3 o'clock this afternoon, we get the Bank of Canada on interest rates. Now, Tiff Macklem, he's the chief at the Bank of Canada. It's widely expected that he will lead a team that will keep the BOC overnight rate at 5%. Last Friday, the Canadian economy missed expectations. GDP growth rate was flat quarter on quarter. Economists expected a 0.3% rise. Let's take a look at what's happening with the USD CAD trade, because it is of interest, despite the fact that the US dollar is really the leading trade here. The dollar has risen against the Canadian dollar. But I wanted to show you this for the significance about the fact that yesterday, if I bring this down here, you can see, yesterday we had a new high here at 13,669. Now, this high here coming through at 13,668, then was beaten. So we're now at levels as of yesterday's high point, not seen since the 28th of March. So the Canadian dollar continues to lose money, continues to lose ground at least, against the US dollar. Be interesting to see what happens today with the interest rate decision. Not so much about whether or not they're going to move, because I think it's generally expected that they won't move, and there's lots of evidence to suggest that they should keep interest rates where they are. It's all a question about what they will say and what Macklem will say in the press conference. So watch out for that. And if you are long on this, your stop goes below the underside of yesterday's candle, down around about the 135.80 level. 136.39 is where we are. 136.69 is the line to break. And then there's not much then stopping it all the way on up to the highs that we had there back in March this year at 138.62. So we'll have to see how things develop, but watching the Canadian dollar ahead of that decision later on today. I think it's 3 o'clock UK time today. Over in the US, a quick look at what's expected there before we move on to other matters. US trade deficit is expected to widen to $68 billion in July at 1:30 p.m. today, after a deficit of $65.5 billion in June. Also get the ISM Services PMI data out 90 minutes later, 3 o'clock today, expected at 52.5 in August, marginally down there from the previous month. So some economic data in the States to watch out for, and it could well give us a little bit of a twist to what's happening with US markets later on today. Angeline will cover the trade numbers live on Beat the Street at 30:30. Now, are the Japanese authorities ready to intervene in the markets to strengthen the Japanese yen? There are two factors to this trade I think it's worth looking at. The dollar rose to a near 6-month high yesterday against the Japanese yen at levels there, 4th of November, the 10-month high yesterday. High US yields give an excellent reason to buy dollars. Who wouldn't? The dollar basket rose to 104.52 on Tuesday afternoon, its highest level since the 15th of March, and it's now trading at 147.24. On the other side is the yen. Why hold Japanese currency when you need it just for funding? Yields are here to continue to scrape along the bottom. Part of the policy of the Japanese government to avoid steering the economy back into its multi-decade policy of deflation and poor growth. The dollar-yen chart is moving up. As I said, the dollar yen at the moment at 10-month highs. The dollar basket, just to quickly reference what's going on there, that high you saw yesterday there was a 6-month high up to the 14th of March. So we'll have to see how things continue there, but certainly looks as though we could well end up seeing some sort of intervention from the Bank of Japan at some point. Now let's move on to some of the corporate news headlines. The WH Smith earnings out this morning, leading the moves this morning. I think we could well see a little bit of an uptick on the share price of WH Smith at the start of today's trade. Revenue rose 28% according to the figures out this morning on this trading statement, year over year, driven by travel. WH Smith continued to benefit from recovery in passenger numbers across all key travel markets, up 42%. Strong summer trading, full year in line with expectations. High Street revenue falling 1% in line with the company's forecasts. The stock of WH Smith is interesting. In the last couple of days, we've seen it peak above this line that I've got drawn on here, which is a previous line of support from the 27th of April at 1508. And this is a market move which is now of interest. In the last couple of days, we've seen it peak up to levels there not seen since the 21st of July. As I said, it looks, broadly speaking, pretty good. But my question is how much upside have we already seen in the stock, which might also reflect where we are going with that stock from here. Halfords trading statement, another one which we could well see a move at the start of the day's trade. In fact, it looks pretty good for Halfords, broadly speaking. Revenue up 14.1%. Auto centres up 34%. Retail revenue generally up 3.7%. Strong services, we're talking about bike business amongst other things. Of course, it does have a big bike servicing business. And B2B performance accounting for 48% of group revenue. B2B winning a significant nationwide contract, you might remember, with Yodel a short while ago. And this is benefiting the business. Underlying services markets remain robust, it says, whilst discretionary categories have been softer in the second quarter to date versus the first quarter. Talking about bike servicing, we were talking before we went to air about this, and we were reminding ourselves that there's competition out there in the market for bike servicing, with QuickFit now delivering servicing in centre. So there's an opportunity there for QuickFit to pick up some business, but certainly competition will keep prices down for consumers, which can only be a good thing. But it is a headwind for Halfords. Trading year to date in line with expectations at Halfords, fully underlying profit before tax expected to be between 48 and 58 million pounds. Now let's take a look at the Halfords share price chart, because it is of interest, if only for reasons to see that it's bumping along the bottom. It's not too far removed from the recent lows that we had down at 178 pence. The stock will open at 187.1. I think this is potentially a positive stock story. If you're long on this, stock goes underneath the underside of yesterday's trade, down around about the 182 pence level. If you're a day trader, certainly looking for a break of the 190 level, and then on to the possible up here. This is the £2 level, which coincides with the 200-day moving average. Let's stay on the charts. Just quickly run through a couple of other companies worth watching. Barrett Developments, full year pre-tax profit falling 884, falling to 884.3 million, broadly in line with company expectations of 882. House builder forecasting difficult trading conditions over the coming months. This basically is more of the same for these house builders. And staying again on the chart, just want to update you on Restaurant Group as well. I sort of had in the back of my mind not to cover this morning, but in fact there's a positive profit alert this morning coming through from the company. I thought I'd highlight this. These are interim results. Increase in management expectations for the full year EBITDA and excellent progress, it says, in executing medium-term plans. Strong like-for-like sales and adjusted EBITDA growth driven by Wagamama, the pubs and concessions. Trading performance supporting a moderate increase in management's full year 2023 adjusted EBITDA expectations, according to the statement this morning. And the company will continue to actively explore strategic options to further accelerate margin accretion and deleveraging. Now, where do we go from here? Closed out yesterday at 43.1. Your stock goes down here at 40 pence, just underneath this rising line of support. If you are long on this, your price target is now the highest that we saw there back on the 8th of June at 47.5. And then there's a further line to watch out for above that, depending on how robust the response is today at 51.6 pence. That's a long way off from where we are at the moment. It's been like around about 20% off. So I'm not suggesting we're going to get anything like that today. But I think broadly speaking, Restaurant Group looking particularly positive after today's numbers. Now, oil futures jumped yesterday afternoon to a near 10-month high for both Brent and WTI after Saudi Arabia and Russia said they would extend voluntary oil cuts, supply cuts, through to the end of the year. Let's take a look at the statement. Saudi Arabia says will extend its voluntary oil output cut of 1 million barrels per day for another 3 months until the end of December 2023. The US and Western allies have urged OPEC Plus to raise output to secure lower energy costs and help the global economy, thus trying to keep inflation down. But this is a big blow on a political level, as the voluntary curbs allow the Kremlin to collect more revenues to fund its war in Ukraine. And you remember, of course, that despite the fact that Russia's behind this idea to extend the cuts, Russia is selling oil round the back door to the likes of China and also India, according to reports. And that is sort of bleeding through what is otherwise a system of control on pricing. But nonetheless, this idea that we're seeing a continued squeeze in supply has seen a new recent high for the oil markets. Let's take a look at Brent. Yesterday, that spike higher there took us to levels we'd not seen since the 17th of November. Not trading too far away from the highs, 89.78, just below that $90 a barrel level. So if you're long on this, stop goes below recent price action. And it's pretty much the same sort of thought on US crude. Same sort of spike up yesterday. A little bit of a pullback at the moment. But nonetheless, if we see a continuation of this idea, we're going to restrict the amount of oil in the markets. And I think that will continue to pick up. That, of course, has long-term implications for inflation, long-term implications for the direction of the travel of interest rates, and potentially then the possibility of increasing the chances that we could well see some economies go into or stay in recession. Let's just end up with a look at what's happening on the oil markets, on the gold markets. Down day yesterday, in fact, one of the biggest declines on the market since the end of July. And we're holding on to that at 1926 at the moment. Direction of travel, difficult to determine. We've got support down here at 1911. If you break these highs, you're then on the way potentially up to 2000. But to be honest with you, it doesn't look like that's going to happen. I think it's more likely to drop with more money coming out. So long as the dollar rises, you've got support down here just below where we are. So that's likely to be an area of interest. But it's not necessarily worthy of a trade at the moment because the oil markets really aren't moving that much. That's it from me. Do watch out for Halfords and the Restaurant Group at the start of today's trade. Two stocks of interest, certainly at the beginning of the session. Also, WH Smith. We're back at 10:30 with Charting the Markets. Hope you can join us there for that. And as I said, Angeline's back at 1:30 with Beat the Street for our new US Look Ahead show.